The broadcast is now starting. All attendees are in listen-only mode.
Hello, good evening, everybody.
Hi.
Yeah, welcome to the Bursa Malaysia webinar this month. And in the beginning of the month, the topic we're going to do today is the power of earnings. Now, as you know, earnings is very important and is probably one of the few key indicators that will propel the share price upward or downward depending on the business performance. So today we are going to dissect how important is earnings. All right, today we are very excited because we have invited a very experienced speaker and also a veteran remisier in the market to talk about the power of earnings. He is none other than Alex Liu. So, okay, as usual, before we begin, we need to talk about the most important slide, which is disclaimer. Now, in the webinar, we're going to talk about a few companies. So, what we want to tell you is that whatever we share as a case studies does not represent any buy or sell call for the certain stock. Okay, if you decide to buy any company or sell any company out of today's webinar, you do it at your own risk. Okay. Now, Bursa Malaysia has arranged a series of webinars as beginner topics. If you are more new to the market, you may want to book every first Tuesday of the month for our beginner session, which we do it right today. We talk about power earnings. Okay, so next month, first Tuesday of the month, we're going to talk about REITs. Of course, if you're a Chinese investor, you prefer to learn in Chinese, then you can stay tuned for our every second Tuesday of the month. We'll talk about webinar in Chinese. Okay, for example, next Tuesday we're going to talk about how do we get close to the market. So in Chinese, it's read by 如何贴近市场. And on the third Tuesday of the month, we usually cover the more advanced or intermediate topics. All right, and today it gives me great pleasure to introduce the speaker next to me today, and I want to thank him for spending his precious evening with us to talk about the power earnings. Okay, he is a financial professional with background in stockbroking, equipment and project financing, commercial credit, loan documentation, and credit administration. He has been a capital market service representative since 1994, so it is a good 25 years, okay, in the market, and is currently a remisier attached with the Kenanga Investment Bank. He having the wealth of experience in the capital market. He has contributed his ideas and experience in the following ways, in which he is a publisher of an investing weblog called Next Trade since 2006. He is also an official blogger for Malaysia Stock the Biz. If you are investing in the market, it is one of my usual go-to websites for quarterly results. And then he's also a presenter for the Capital Today program on Capital TV. He's also a social issue columnist for the Medical Review, a Chinese news portal in 2011. He has also conducted investment education programs on Bursa Station, Share Investor, as well as on webinars on kclaw.com. He's also a graduate member of the Chartered Institute of Management Accountants. Okay, so very welcome to join us today, Alex.
Thank you.
All right. So today, what are we covering today?
Thank you, Sean. Yeah, today we will be covering about how to pick stocks that would appreciate over time. So this stock that we'll be picking should be earning, have good earnings, for example. In fact, they are the most important criteria for most stocks going up. That is, they have good earnings. So the topics that we'll be covering today would be the basic rule and assumptions. How do you assess stock earnings? Finding stocks with earning breakout, finding stocks with rising earning. When you compare earning trend with price trend, using price to earning to growth ratio, and finally, how to assess a loss-making stocks for purchase. Right. So we're going to jump straight into the basic rules.
Yeah, looks exciting. I can't wait to
Right.
get it started.
Thank you, John. Now, the basic rule is simply this. The price of a stock is determined by two factors. Number one is the earning of the stocks, and number two is the price to earning ratio or multiple. So this formula, actually it is a formula for price to earning ratio. Price to earning ratio equal to price divided by earning per share. But if you represent it slightly differently, price is equal to earning per share multiplied by price to earning. So if the earning of the company increase, that means naturally price must increase. If the price to earning ratio increase, the price of the stock would also increase. And most importantly, if both the earning and the price to earning ratio remain unchanged, then the share price would remain unchanged or stagnant. So these two factors, let's look at it. What do you make of earning per share? Now, some people will want to use last financial year earning per share, which would be probably a little bit out of date. Others will want to use the current year estimate earning per share. Now, for most of us who are retail investors, we probably would have some difficulty doing projections or forecastings. So that is also probably something that you may not want to use. Finally, you would have forward earning. Now, this would be for the analysts because they would look at the stocks every day. Now, for me, I like to use trailing earning per share. What it means is that it is the earning per share for the last 4 quarters. Some call that the rolling 4 quarter period earning per share. Now, the next thing is the PE of the stock. What is the PE of the stocks? I'm not referring to specific numbers because it changes all the time, but I'm talking about the general gut feeling about what is the PE of a stock. So take, for example, the last 2 years, the stock market has been grinding down slowly. Now, what sort of PE is that? The PE in a bearish market, like what we have for the past 2 years, predominantly, of course, occasionally, we have bouts of rally and the prices would rise, but generally over the last 2 years, it has been grinding down. The PE during this period would be the price that the seller is willing to accept. That means it is the buyer's market. So the PE will be generally lower. Now, this is quite different compared to before that. Before that, prices were rising up, especially right after 2009. That market, the PE would be what is the buyer willing to pay for the stocks. So generally in that kind of market, in a bull market, PE would be higher. So PE is determined by the direction of the market, right? If it's a bull market, the PE would be higher. Now, in the sideways market where PE is relatively stagnant, for some stocks, the PE can still rise if there is a bullish sentiment. And it is a funny thing because this bullish sentiment is fed on by expectations that comes from, for example, rising earning. So if a stock have rising earning, the PE would also be going up. So this would actually bring up the stock price faster, which is why we today have this talk about the importance or the power of earnings, right? So now I'm going to talk about how to assess a stock earnings. And I will begin with the most basic way of doing that. For beginners, I think you will appreciate it. For the more experienced one, let's take this as revisions of what you may have been doing in the past few years. Right? Let's talk about the summary of key financial information. This is what you will see announced to Bursa Malaysia for the quarterly result. This quarterly result is to be announced within 2 months after the end of each quarter. And what you're looking at is the quarterly result for 30th June for Kwan Chong Berhad. Right. I'm going to quickly now run through with you what are the information that's available here. Now you will see 4 columns of numbers. The first column here is the last quarter result. The next column is the same quarter but last year's result. And then the third column would be the year-to-date result. So year-to-date is defined as the first day of the current financial year, which is in the case of Kwan Chong is 1st January, and the last day of the last quarter, which is 30th June, which effectively make it the first half results. So this would be the first half result for this year, and the next one would be the first half result for 2018. Okay, I think that's very basic. And if you look at the first 4 rows of numbers, you start with revenue, self-explanatory, right? And the next 3 rows of numbers are the 3 profits numbers: profit before tax, profit after tax, and net profit attributable to the shareholders. So the difference are simply profit before tax, you minus tax, you get profit after tax, and then you minus minority interest. These are share of profits that belongs to other shareholders, minority shareholders in subsidiaries which are not wholly owned by the group. So in the case of Kwan Chong, there is no such subsidiary company, so the net profit numbers is same as the profit after tax numbers. And then you will have the earning per share, which is simply the net profit divided by the number of shares. And then you have dividend per share. And then lastly, you have the book value or the net assets per share. So very quickly, if you look at these numbers, the quarter-on-quarter comparison shows a big jump. It's a jump of around 250 over million ringgit. And when you look at the first half this year compared to last year, it's also a big jump. It's about 400 million ringgit. So the performance of this company in terms of revenue is substantial increase. And what is more is that the profit of the company also increased substantially, right? And that will flow into the earning per share, right? And of course, you would expect the dividend per share to increase. There's a slight twist here. You see that the dividend per share actually dropped this quarter. Is that so? But if you look at the first half dividend is actually increased. What happened was the company decided to pay out dividend quarterly this year. So they pay out 1.5 cents in the first quarter and 1.5 cent in the second quarter, which make it 3 cents. And that is more than the single payment of 2 cents that was done last year. So there's an increase in dividend as well. So overall, this is a company that is doing very well, very good profit. So you will be very interested to study further on these stocks. Now, normally what I would do is I would prepare a 8-quarter table. This is how it looks like. And I think those of you who have visited my blog will have seen this many times. I would tabulate 8 quarters of results, revenue, profits, and so on. And then I can see the trend. Right? Like you can see here, September 2017, the revenue increased from 540 million to last quarter is 753 million. It's a big increase. So there's a trend of increase in revenue as well as in profit for these stocks. And the second reason why I prepare this table is, you can see the small table at the bottom here. I compare the result for June 2019 with the immediate preceding quarter, which is March, as well as with the same quarter last year. So I compare them here, and I can actually show very clearly the increase in the performance when you compare to the immediate preceding quarter, as well as when you compare to last year. It's a big jump in the result of the company. Now, you can take this one step further. Yeah, this is what I normally do. I would take this one step further by adding up the result for the immediate rolling 4-quarter, this immediate rolling 4-quarter periods. I add up the revenue, profits, earnings per share, dividends, and then I also would add up the previous rolling 4 quarters results, and then I compare the two of them. You can see that if you assume this to be a full year, I mean, this is a full year, but this is not the financial year of this company, and you compare that with the preceding full year, then you can see that there's a big jump in the revenue as well as the profit numbers. But more importantly, I have actually added up the earning per share for this 4 quarter, as well as the dividend per share for this 4 quarter, and I show clearly what is the book value of the stocks. By doing that, I can then move on to do a valuation of the stocks, right? So the three most common valuation multiples or ratio that we can look at would be price to earning ratio, which is arrived at by taking price of the stock divided by earning. So the price here is for August 23rd is 4 ringgit. Divide that by the earning per share. If you go back, the earning per share is 46 cents. The dividend per share is 5 cents. And the book value is 162. All right, we go back again. So it is 4 ringgit divided by 46.26 is equal to 8.6 times. And price to book, which is arrived at by price divided by net asset per share, is equal to 4 ringgit divided by 162 is equal to 2.5 times. And dividend yield, which is dividend divided by share price, so it's equivalent to 1.25%. So what does that mean? Well, if you look at a stock that generate good growth, the kind of PE that you're looking at, 8.6 times, may looks very attractive, right? But you may want to also compare with other company in the same business to make that judgment call. So, but basically, these valuation multiples give you a good feel about the company, about whether you are paying a fair price for the stocks if you choose to buy the stocks, right? So the next thing we are going to look at would be looking for stocks with earning breakout. Now, I can take the 8-quarter table just now, and I can extend it further. I like to do that, and I can sometimes extend it as far back as 40 quarters, which is for 10 years. And the purpose of doing that is to actually plot a graph. And then the beautiful thing about plotting a graph is that actually the connection, the trend, and most importantly, breakout would be clearly visible, right? Take for example, this graph here. Now I'm going to zoom in, right? It looks like this. See, the revenue is growing up. And this is the profit, the trend. You can see that it exceeded this level here. Now, in technical analysis, we always say that when a share price has a breakout, it will continue to go higher. I like to believe that the same applies to the earning of a stocks. If the earning of a company were to go higher, there is a very good chance the share price will continue to go higher. Right. So that is on earning breakout.
So when there's earning breakout, the share price may have a breakout.
Yes, that is generally the idea. So I'm going to move on to finding stocks with rising earning, and I'm going to introduce you to a different way of looking for trend. Earlier, I spoke about trailing earning per share.
Which is the PE ratio which is the earning per share that you look at instead of the last financial year. You look at the rolling 4 quarters.
Right. It is the earning per share for the last 4 quarters. They like to call this the rolling 4 quarter period earning. Right. So I take that and I apply into this particular table. What I do is this, right? For each of these quarter, let's say the current quarter is June 2019, right? Now, for this particular revenue number here, if you are looking at up here, right, you're looking at the revenue, or I put it turnover, but it's the same. It's the revenue for that particular quarter. But what if down here you add up the revenue for these 4 quarters, right? 4 quarters up to June 2019. So this is the rolling 4 quarter period revenue up to June 2019. And you do that for the rest of the quarters. You just put a formula here, is equal to this number add up all the way here, 4 quarters revenue. And the same you do for your profit before tax as well as your net profit. You add it all up. So effectively, every single number here, be it for the revenue or for the profits number, it is actually a full year result, right? And when you plot it,
Yes. Yeah. Actually, there's no point for you to use this because they can't see.
oh, they can't see it. All right.
They can't see the laser. Only I can see the laser.
Okay. All right. Okay. So if you look at the table for whether it is revenue or for the profit table, you can see that it will become a trend, and it is going up very clearly. So if you zoom in, right, if you zoom into the profit table, you can see there's a breakout, and the breakout actually happened in December of 2017. December of 2017. It is most probably same as the breakout in the quarterly result as well. So when you see this and then you look at the price trend, the price chart, you will see that it's also reflected in the share price. So let us go there and we look at earnings trend versus price trend, right? Just now we were looking at, okay, I put in there 2 green arrows. Now at the bottom would be the profits for the rolling 4 quarter period up to each quarter. You will see that there is a breakout. The first green arrow on the right hand side, right, at the chart below, there's a breakout, right? And you can see that on top on the price chart, there is also a breakout. And you go back a little bit further in 2019, there's also a breakout, probably in March of 2010. And it is also reflected in the breakout in the share price in probably March or April 2010. So when you do this analysis, you are looking for earning breakout because it would translate into a price rally for the stocks. So that's why we are doing this. So let's move on and talk about using price to earning to growth ratio.
This is
Do
a
you
little bit more advanced indicator.
Yes, this is one of Warren Buffett's favorite indicator.
It's also
Yeah.
my favorite indicator.
Warren Buffett has said that if you see a growth stocks trading at a PEG ratio of 1 time, it is very attractive. Right. Now I'm going to use two rubber gloves stocks to do the study and then to show it to you how it works and how we can actually use it in our investment decision. Now, firstly, I just repeat about price to earning ratio, which is actually price divided by earning per share. Now, price to earning to growth ratio is PE, and that's price to earning ratio, divided by earnings compounded annual growth rate. Normally, they will take it for, say, 3 years. You can take it a bit longer than that, but it is fine. The idea is that you want to divide that by the growth rate of the stocks.
So Warren Buffett suggests use how many years?
I think he used 3 years.
He used 3 years.
Yeah.
Oh, for somebody who has so long-term perspective, he used 3 years.
Yeah, I think he just used the standard. But in my example here, I'm going to show a little bit longer than that. Right. Now, I'm going to talk about HATA. Now, this is a graph that you would plot using what I just talked about, the rolling 4 quarters period numbers, right? And this is the graph for pre-tax profit and net profit. Now I included in the moving average line, the 4 quarter moving average lines. I like to believe that when the number cut the 4 quarter moving average line, it means that it's going to turn either positive or negative depending on how it is cut. So for example, if you see on the right hand side, it is cut to the downside, that means that it could be negative. So I want to study the technical part of it and see whether how far this will go. So I put it down there for you. So what you should be looking for is the 4 quarter net profit numbers, and that is in pink. So if you look at the most extreme right number, it is actually 425 million. Now I repeat that this is the number for the net profit for 4 quarters up to June 2019. So effectively it's 1 year profit, but it's up to June 2019. And if you go back 10 years, and you look for the 4 quarter net profit for September 2019, then you have a number of 103 million ringgit. So anyway, I'm going to jump to the computation of the compounded annual growth rate for HATA. So 103 million ringgit has increased over 10 years to 425 million ringgit. So that is a compounded annual growth rate of 15%. Okay, I'm going to go back again and look at the second stock, which is Corsun. Corsun, in the same period, the profit increased from 58 million to 228 million. And if you plug it in here, by the way, this is something that you can use in the internet. You go to moneychim.com, you can use this. So you just have to include in the present value, which is 58 million, and the future value is 228 million over a period of 10 years. The growth rate is 14.5%.
Yeah, the future value doesn't mean that you forecast. It just means that you take the recent one.
Yes.
Present value means you take 10 years ago one. Okay.
Right. Yeah.
So it's not to be confused.
Yeah. Okay. So you have to do it the past is actually the present, and the present is actually the future. So the idea is there, right? So okay. Now, firstly, we're going to compute the PE of the stocks, and as well as later we'll compute the PE to growth ratio. Now the PE of the stocks, you can see clearly based on the price for August 23rd, right? Price divided by earning per share. The PE for Hata is 40 times, whereas the PE for Kosan is 23 times. Why is that so? Well, if you look at the compounded annual growth rate, it's roughly about the same. It's about 15% or thereabout. So when you take earning PE and divide it by the compounded annual growth rate, you find that the PEG ratio for Hata is 2.65 times, which is way higher than that of Kosan, which is 1.62 times. Why is that so? Would that make Kosan a more attractive stocks than Hata? Now, at this point, I want to introduce something that I read somewhere about the concept of high reward and low risk investing by one fund manager by the name of James Rea. James Rea was a contemporary of Benjamin Graham, the father of fundamental analysis. So James Rea went to Benjamin Graham and told him about his idea of high rewards and low risk investment. And Benjamin Graham, having met so many people who pitch him on investing idea, asked him, please explain, but don't use mathematical model or formula. So I just explain in a layman term. And so James Rea explained about stock picking using his method, and he compared it with selecting a cow, right? Stock picking and selecting a cow. He says that if you want to select a cow, you want to pick one that produces a lot of milk. So in the case of stock, you want to pick a stock that has a lot of earning. It makes sense, right? And the next thing is you want to select a cow that produce milk that increase year after year. So in the case of stock, you want to pick a stock that has earning that keep increasing. And the increase in the milk output should be preferably consistent or at least steady. So if the increase is like 5%, 5%, 5%, this is more. This is preferred to if the increase is 10% and next year there's a contraction of 5% and then there's an increase of 15%. A steady increase is always preferred over erratic sort of increase. And lastly, he talked about converting your milk into cheese. So we say if you can convert a lot of the milk into cheese, because cheese can be sold at a higher price than milk, that is much preferred than just milk. So in stock, the earning of the company is good, but dividend is preferred. So the company that pay more dividend is always preferred. So now we're talking about high reward. Later I will talk about the low risk. So on this high reward, the second point is about growth. You prefer growth to be steady. So let's go back and look at the chart for Hata and Kosan. Now take a look at that. Now this is Hata. How would you describe the growth? The growth, except for the last 2 quarters, which is a pretty sharp dip, is very smooth. Would you not say? It's very, very steady growth. Maybe nothing spectacular, but it is steadily rising. Compare that with Kosan. It looks quite steep at times, but then it also dropped back quite a bit after it has gone up a lot. Now, applying James Rea's idea about growth and consistency of growth and volatility of growth, it seems that our investor prefer Hata over Kosan part of the reason is that the growth is very steady, very consistent. And for that, well, they paid this stock a PEG ratio of 2.65 times. Personally, I find that maybe Hata is a little bit overpaid. Maybe Corsan is a little bit penalized too much for the kind of volatility. But of course, that is a decision for you to make. Then, assuming that you are to tweak the number a little bit, all right? So let's look at that. Right, this is the same table I put in at the bottom there. 3 scenarios. Now, the first one is the base scenario. Now, the base scenario, the PEG ratio is what is the existing PEG ratio, which is 1.62. And at a growth rate of 14.5%, the PE should be 23.43 times, which is the existing PE of the stocks. And you multiply that by the earning per share of 17.84 cents, you have 418, right? The current price. Now, you look at 2 possible scenarios. Scenario number 1 is that if the PEG ratio for Corsan is halfway up to that of Hata, well, it will become 2.1 times. 2.1 times the compounded annual growth rate of 14.5 will give you a P of 30.45 times. And if you multiply with the earning per share of 17.84 times, the price of Corsan would be 5 ringgit and 43 cents. And if you were to assume under scenario number 2 that it have a PEG ratio same as Hata, 2.65 times, then the PE will be 38.43 times, and the price will be 6 ringgit 86 cents. So, depending on how bullish you are, a case can be made that if Corsan were to close the gap with Hata, meaning Hata's PEG ratio is back a bit, Corsan PEG ratio goes up a little bit, it would probably make sense for people to consider Corsan for investment stock. Right. That is for P and PEG. And I would now like to quickly move on to when a stock moves from being a good earning stocks, but very little growth, and then growth came in, and what happened to the stocks share as the share price, and that is the stock here we are looking at, which is RG. RG, as you can see, for quite a long time, in 2011 to 2014 was trading around 4-5 ringgit mark, and then it broke up in 2014 to go up to about 6 ringgit, and then it shot up all the way to 17 ringgit. So what happened to this stock? I would now like to show you the same table that I spoke about earlier, which is the rolling 4 quarters period profits numbers. You can see at the bottom there. Again, I show you the 4-quarter numbers for profit before tax and then net profit. And I also put in the moving average, 4-quarter moving average on both of them. Maybe I shouldn't have, because it's a little bit crowded there and you may not get a very clear picture. So if you look at the pink line, right? The pink line would be around 26 million. So in the end of 2014, the net profit broke above 26 million. And that's when the share price of RG shot above 5 ringgit and slowly moved to 6 ringgit in 2014. And then for a while, the profit seems to be not willing to go up, was remaining around the 40 million mark, and then it went up again. It shot up again. Sorry, not the 40 million mark. It's the 30 million mark. It shot up again. That was towards the middle of 2015, and that's when the share price rose from 6 ringgit all the way to around
26.
26 ringgit. Yes, 26 ringgit. So let us zoom in. You can see more clearly here. All right, from June 2008 until June 2013, the net profit in pink was was hovering around the 20 to 26 millions. This numbers 20 to 26 million is full year number, meaning it is the result of 4 quarters net profit added up together. So the time when it broke out was somewhere around December 2014, and then the share price, sorry, the net profit start to rise steadily from 30 million all the way to 60 million. Look at the pink number, all the way to 60 million. So that is 6 years of increase from about 24 million, that was before the breakout, up to 60 million over a period of 6 years. And using MoneyChim's compounded annual growth rate calculator, we can actually compute this compounded annual growth rate was 16.5%. So, all right, now I put it side by side with Hata and Corsan, even though this is a F&B business compared to a rubber glove. But the point I want to make here is with regard to growth stocks. You can actually see very clearly the PE of RG is 18 times. That is the result of you're dividing the price of 17.78 by the earning per share of nearly $1. So it's about 18 times. And you can also compute the PEG ratio. The PEG ratio is the second table, the middle table. You take the PE 18.28 divided by, just now we have this compounded annual growth rate of 16.51. You divide by that, you have the number PEG ratio 1.11 time, which is very close to what Warren Buffett would consider a value stock. So RG is fairly attractive. So let us run some scenario here. The base scenario is the current PEG of 1.11 time, which gives you the PE ratio of 18.28 and the share price, current share price 17.78, or rather the share price as at August 23rd. So if you were to assume that the PEG ratio were to go up to say 1.5 times, PE would be 24.77 times, and the share price could hit 24 ringgit. All right, and of course, if you are even more bullish than that, if you assume a PEG ratio of 2 times, P would be 33 times, and the share price will be 32 ringgit. So it depends on how you look at RG and your own assumption as to whether RG can actually achieve the kind of growth. What we do know is that today RG has made plan to build another plant in Seremban, which will be ready in the year 2022, if I'm not mistaken, in 3 years' time. So between now and then, the question is whether the capacity is there for them to continue to grow. If the capacity is there, then there is no reason why this stock should remain at a PEG ratio of 1.1 time. It should probably go up to more than that. Maybe not 1.5 time, but probably a little bit more than 1.1 time.
All right. Can you go back to the slide? One more. Yeah, I want to ask you. I remember RZ has one extraordinary gain from the disposal of land.
Yes.
Yeah. Did you Did you take the extraordinary gain out from when you were doing this net profit chart?
Thank you. That's a very good question. In computing all these profit numbers, you should exclude non-recurring profits. So that one is a non-recurring. It's one off. If you added in, there will be a sharp spike up, and it would not make much sense. What we want to capture is the core earning of the company. Yeah.
All right, so it's drawn based on the core earning, but the share price actually reflected based on the the land sale. Okay,
Yes.
the land sale was rumored, and then the
Yes.
share price started to climb.
Yes, but actually the big jump was much later. The price started moving up not because of the land sales.
Okay.
Yeah.
All right. You can carry on.
Okay.
So now let's talk about how do we assess
All right.
loss-making stock.
All right. Now, how do you assess a loss-making stock? Now, just now we talked about James Rears and Benjamin Graham about high reward and low risk method of investing. If you can remember the 3 points for selecting a stocks to ensure you have a high reward. Number 1 is good earning. Number 2, earning growth. Number 3, dividend payment. So this would help you to select a stock with a good reward, high reward. Now, Benjamin Graham heard the same pitch from James Rear, and Benjamin asked James, what would happen if your cow, stopped producing milk? So James replied that if the cow stopped producing milk, then I would have to slaughter the cow and sell the meat
Make a cheeseburger.
sell the meat to recover the investment, right? So it is very important that you do not buy a stock that is at a price way higher than the underlying assets of the company if you have to close it down and sell it off. So in which case you're talking about the net assets value of the stocks. Of course, sometimes when you want to sell off a company net assets, you may not even get the full asset because it's a fire sales and all that. So you may get it at a discount to even that. So the whole idea is that if you are paying, let's say, 3-4 times that of the book value, then can you imagine if the company were to close down, you're going to have to lose that much. But if you are buying close to the book value, then chances are your loss will be less. So I use that idea to try to determine if I were to buy into a loss-making company, what would be a good price to buy. So I take a look at Lafarge Malaysia Berhad. So, okay, on the top there you have the price chart. At the bottom you have the profit number. So you can see the profit this is a yearly profit. This is not the rolling 4 quarters. This is the audited final result for Lafarge from 2000 and 2000 all the way to 2018. Right. You can see that even in 2005, that was a pretty bad year. They still managed to edge out a small profit. But this round in 2017 and 2018, the company made an actual loss.
Make losses.
Yes. So how do you then come to a conclusion you can buy because it is still making losses? But if you look at the price chart, the price chart is actually up to August 23rd. The price chart actually show a spike up. Now, ignore the spike up for a while because this company has been taken over by YTL Group and they offer a price of 3 ringgit 60 cent. So the share price rose from a low of 180 all the way to 360, which means it doubled up. Now, if you are to ignore that, my idea is that what would be a good price to buy so that you minimize your loss. You wait for this stock to recover. Bear in mind that Lafarge accounts for close to 50% of Malaysian cement production. When the property market recover back in a year or two's time, and when all the big projects go into full swing, surely the usage of cements will be there, and then this company will return to profitability. So you want to position yourself, when is a good time to buy? So if you use James Rea idea, so what you can do is this: you can produce a table, right? The first row is the share price end of the year. This all the way from, well, it start on the left hand side is December 2018, but it go all the way back to December 1999. That will be the share price at the end of the year. And the second row is the book value, NTA per share. And if you take the price divided by the NTA, you have the price to book. You will notice that at the lowest point now in December 2018, it is 0.6. The last time it make a low similar to 0.6 was in December 2005, right? After that, the share price will recover, right? Well, let's look at it in the you put the price chart on top and the price to book ratio at the bottom. You can see very clearly that the last time 2005, that is the price to book would be the yellow line. It was close to the bottom, and if you were to buy, then it is, well, it is probably just 20 to 30 cent before the bottom, and then it recover back all the way to around 10 ringgit. So if you have applied the same method this round, you would have bought, say, well, it would be ideal to buy at 180, but assuming you buy it bought it at 2 ringgit, you would have made handsome profit after the recent rebound. So I think that this is one way you can get into a loss-making stock, but you have to be fairly familiar with the business. In the case of Lafarge being one of the strategic in the strategic industry, producing cement, you know that it's a matter of time the business will come back. You can actually consider buying it. You must also take a look at the financial position of the company and the shareholder strength as well. And you can actually buy it and wait for the recovery. And the return in this case is 100% from the low. I think that is worth a good bet on these stocks. So, ladies and gentlemen, that is my sharing for today. I like to just give you 3 pointers to remember. Earnings is the most important factor in stock picking. So because earning drive share price movement. Secondly, try to catch earning breakout, because earning breakout has a tendency to lead to price rally. And when the earning goes into a trend, especially after the breakout, try to stay with the stock. Try to, well, like you do in technical analysis, you say that the trend is your friend. So is earning trend. It is your friend. Stay with the stock so that you get the maximum benefit out of it. So, ladies and gentlemen, that is all I have for you today. This is my blog. You can come and visit it. And on the front page, which was a few days ago, I posted on the One Chong Bahat. I'm happy to take your question if you have any. Thank you.
All right, thank you very much, Alex, for your sharing on the earnings. Okay, today we learned that so long that you have earning, we can stay on, and we learned that when there's earning breakout, maybe it's time for us to really go into the stock and capture the kind of momentum that will be carried on by the earnings. Okay, so if any question, you can write in the question box and kindly write your questions in full sentences so we can help you to ask the speaker about any burning questions that you have in mind right now. And while you're writing your questions, I would like to launch a poll and to see how do you think the market will go tomorrow. So where do you think the FBM KLCI will go tomorrow? Do you think it will go up 20 points? Or do you think it will go down 20 points? Like today, I think we went down a little bit like 20 points, or you range in between negative 20 points and up 20 points. Okay, so let's spend about half a minute to collect some response. And in the meantime, if any questions, please write in the question box. Okay. Okay, we have 60% of you voted. So let's close the poll and share the result with you. So on your screen, you see that 9% of you think it will be bullish tomorrow. 77% of you think that it will range in between negative 20 and plus 20 points tomorrow. And 40% of you think that it will be down more than 20 points tomorrow. Okay, so that is the survey, market survey. So yeah, let's go back to our um, question and answer session. So now the first question I have on my screen is that like I want to ask the speaker is that how do we shortlist the stock, because I don't have the time to do like 10 years numbers for 900 over counters.
Okay, how do you shortlist the stock? I think one of the best way of of doing what you want to do, shortlisting a stock, is to use the filtering system. You can set in your parameter, like for example, you want 10 years of profit, and how much profit are you looking at in terms of return on equity, what's the percentage and all that. And also you set in what is the P that you want for the stocks. It should, if you set it very tight, for example, you want the P to be less than 5 times, then you may come up with a very short list. Or you may want to have a longer list to then slowly weed out. Then you may want to set it at a slightly higher numbers, maybe say 10 times. Then you slowly go through that list. Right. The important thing is setting the parameters. Yeah, the parameters should include PE ratio, should include the number of years of profit, and also maybe return on equity, so that there's a certain amount of profit in a certain amount of return. So you would then produce a list of maybe 50 stocks or 30 stocks. Then you study it. And one of the best place to do a quick study, rather than what I do, I actually take the accounts from Bursa Malaysia and one by one extract out, is to go to malaysiastock.biz. Malaysiastock.biz has the quarterly has a table for revenue, profit before tax, profit after tax, and net profit for particular stocks up to 10 years. You can actually copy down the whole thing, put it onto Excel spreadsheet. You can use the chart wizard and plot the chart. You can also put some formula in and do your own rolling 4-quarter periodic numbers for revenue and the profits numbers. So you can actually did what I did just now. I showed to you. You can use that, but you have to do a little bit of work. Do the filtering first, and then go to biz, pick up the stocks, and then you go to the financial performance, and then you copy it out into Excel spreadsheet, and then you do some massaging, and you can get a good feel about the stock.
Okay, so that's how you do. How do you shortlist the stocks? All right. So the next question on my screen is: Is there any screener for price earning growth ratio? Now,
Not that I know of. I don't think so.
you don't think so?
Uh,
I that's also not that I know
Not
of.
that I know
No,
of.
because why? Let me explain. Why is it not so common for people to use for this website to have PEG ratio? Because different people, because it's not accurate. Because some analysts look at 5 years earnings and do the forecast, and do the kicker.
Yeah, could be.
Yeah, some analysts use 3 years, so that's why there's no like a standard rule of how many years of data you should look at before you can get a growth rate, the compound annual growth rate. That's why not many websites provide this data. Most frequent is of course they provide PE. It's like earning per share is like a must have valuation
Yeah.
tool or assessment or yardstick for us to make a good informed decisions. But PEG is hardly seen locally because different people use different measurement.
Yeah.
So
Yeah, that's a very good point.
yeah.
And I think this compounded annual growth rate, the whole idea that you compute it 3 years, 5 years, 10 years, is to give you an indication of what would be the likely growth rate going forward, because you want to pay for growth. There's no point you say, I'm buying this stock which has a 15% compounded annual growth rate, and then pop, the next 2 years actually the earning is dropping. That defeat the whole purpose. Which is why when we look at RG, the question that you want to ask is, why is it 1.1 time? Is it because it has maxed out its capacity? It cannot grow anymore? That is the big questions that you do have to ask. Yeah.
Yeah, good. So if the PEG ratio is less than one, it will mean that the company is pretty attractive, lah. It's more than one.
Oh no, I mean even close to one, whether it's 1.1, 1.2, it is still quite attractive. Yeah, it's quite attractive. When it's less than one, well, I mean that's super attractive.
Yeah, super attractive.
Yeah.
Okay, okay. So if the company don't have earnings, that means you won't be able to, not so easy to calculate because there's no PE.
Yes,
That's
you answered that,
become
yeah.
very PEG become incalculable. Okay, so all right. So let me go to the next question. How do we determine the earning breakout and its duration?
Okay, let me answer that this way. Earning breakout, is it reliable? Is it could it be a fake? Could it next quarter they'll pull back? Nobody can answer that definitely, right? It's just like stock share price. There's a breakout, you jump in, and then it turned out to be a bull trap. It just failed. Sometimes it can happen. So when you have earning breakout, you study the stock carefully, and then you make an intelligent guess whether this can continue. But it's always a question that you could be wrong, but you also don't want to be too late to get into the game, so you can actually take a small position first, and wait for the next quarter results to come in. So then you would be very sure. Then you can continue to add to that position. That is all I can say, because there's no guarantee. It's all about probabilities, and we have to live with that.
Okay. Just the next question I have is that to what extent can we predict the next quarter earning? Like how many of them who use this method try to predict like didn't come through?
Oh, I don't like to predict forecast
You don't.
earning.
That's why you're just trolling,
Yeah,
right? You don't use forward P ratio.
I don't like to do that, because, by the way, for the information of your listener, I I look at the financial result for every single company on Bursa Malaysia.
Wow, 900
Every
companies.
single company.
Do you
Yeah.
tabulate the 900 companies?
No, I don't. I probably have the I compile the data for probably about 1-200 of them, but that's the reason why at the beginning of the slide, if you look at how do you assess a stock's earning from the summary of key financial information, you quickly make a judgment as to whether this company has has an increase, has improved on its financial performance. And if it has improved on the financial performance, you may want to look at the result for the immediate preceding quarter to sort of confirm that, or you might want to do a quick 8 quarter table to just look at the numbers for 8 quarters. Of course, now we have share stock Malaysia stock.biz. We can easily go there, download 10 quarters of revenue profits numbers, and then we can actually just plot out the whole thing, and we can do that all within a matter of 3 or 4 minutes. Compared to those days when I first started in 2006, it probably would take me an hour just to do up 20 quarters result.
Yeah. Okay, I see. Now, the next question is, how did the positive cash flow, operating cash flow, increase your confidence in buying a loss-making stock?
I have to be honestly frank with you. I have gone into cash flow study, and I find that to be quite unnecessary. To be honestly frank with you, if a company has good financial position, and if the company growth in revenue is somehow not overwhelmed by the growth in the debtors number, I just take it that the earning number is good enough, because cash flow is just too confusing and is everywhere. If you have done it before, you know what I mean. It is just zigzagging, so it is no clear trend. So I don't find that very useful at all.
Okay, so you don't find cash flow is an important, useful indicator in your study in terms of earnings, lah. Am I right?
It is good to know,
Good to know.
but it's a lot of work, because if you have done it before, you would know that unlike revenue and profit numbers, you can actually have the summary of key financial information. The cash flow numbers are very different. It is given as a year to date number. Every time you want to extract out that particular quarter cash flow from operation, cash flow from finance, cash flow from investing, you have to open up the immediate preceding cash flow. Right, so it's assuming this is third quarter, you have to open up the second quarter, because the number here is year to date, and the number here is also year to date. So this is 9 months number, this is 6 months number. You have to do a minus, then you can extract out the numbers, then you can plot, and it's a lot of work.
Okay, I understand. So the next question on my screen is, why does it occur that some companies have increasing earnings, but the share price still doesn't move upward? What are the other most important factors that determine increasing share price beside earnings increase? I think there will be a lot of people who have the same questions.
There are two questions here. Yes, it happened occasionally when we look at the stock and we say, oh, this company, the earning is going up, but the share price is going down. Yeah, this happened to companies that are not well followed and nobody covered them. So, and chances are they are earning relatively small. We're talking about $1-2 million. So, what is 1 million improved to 1.2 million or 1.5 million is very small. So it could be that reason that the share price doesn't seem to move with it. In your second question, what was the second question again?
What are other important factors that push the share price beside the earnings?
Well, publicity about the company, of course, that would help. Sometimes, if you go to KOSE i3 investors, you see certain stock has had a forum that has many people talking about it. I presume that when you talk more about it, some of them would buy and the share price will move. I would think that whether it is the company owned investor relation department doing their job, or there are people outside there fanning that particular stock so that the interest there is there. Sometimes a good company, if there is nobody talking about it, the share price won't go up. I think RG is probably one of them. I think RG is not well publicized, even though it's such a big company, because the kind of PE is commanding is very attractive. Yeah.
Okay. Now, so what would you advise, or what would you encourage investor to do if they buy into a company whose earning is increasing but the share price don't move? Do you advise? Would you say that they should cut loss, or would you feel that they should quickly take profit and move, or you should hold on until the share price really reflect the earnings?
That's a very good question, sir. I have to say. I still remember in 2006 or maybe 2007, I began my coverage on RG. Yeah, I have to dig back my information. I remember the stock was trading around 2 ringgit. It was ridiculous PE. It has very good dividend. And we're talking about a stock trading at below the book
Book
value.
value.
Yeah, back then, 2006 or 2007. And
It's crazy to think that Ajinomoto trade below is book
yeah,
value.
it was $2. And if you just add up all the dividend that has been paid over the year,
It's free shares.
it's not only free, your dividend is higher than that amount that you paid for the stocks. And I was telling one of my big clients, I think Ajinomoto is a very good buy. And he says that you should have your head examined, because after I called the stock a buy, for 1 year it didn't move. Yeah.
Still so low.
So yeah, and then from $2 it slowly moved all the way to 5 ringgit, close to 5 ringgit, and then it went stagnant for a long time. And I thought that was the best it got, and I even told some of my clients who bought a few lots, just take profit. Then it break out again, and I told them to buy, and they say, "What? Jump in again? It's $1 higher than where I sold it." So nobody did get in, and this round when it went all the way up to what, 20 ringgit. Yeah, well, that's life.
So you would I wouldn't say advise, because I guess we are not in a area where I can do advisory, but you would recommend that we hold on lah, correct?
I would think that if the purpose of you buying the stock is because it's attractive, yeah, it is having good earning and it's paying you good dividend. The share price is what the market opinion about the stock. Somehow the market didn't have a good opinion. Well, I guess you just have to stick with it. If you're committed to the stock, stick with it and hope for the best. In a year's time, maybe things will change. Yeah.
Now, just now, you said that you studied 900 companies' quarterly result, right? So the question on my screen is that, so which industry do you think that have potential?
Oh, I can't remember that. To be honestly frank, to be honestly frank, a lot of my customer like to ask me, Alex, give me the 5 top pick that I should consider. I can't remember that because I look at so many stocks. I have difficulty. I may remember the one I called just a few days ago, but I have too many stocks, to be honestly frank, to look at, especially right after end of August.
A lot of
Yes,
results.
as you know, it is that is 2 months after end of June, and most company has their quarter ending. Well, if it's not March, it's June, it's February, September, it's December. So it's been a very very busy month. Yeah. Yes.
All right.
All right.
Okay. So, what is the best ratio for PEG based on Warren Buffett's belief?
He didn't say that. He just said that anything that is 1 is attractive. So anything that's less than 1 should be even more attractive. And for that matter, if it's 1.1, would that make it unattractive? I don't think so. I would believe that you have to be substantially above 1 to be well fair. Maybe 1.5 or 2 will be fair. That kind of things.
Okay, so the next question is, how do we know what is a fair P ratio in a certain industry?
And that is very tough. I mean, if you really want to know it, what you would do is you take out the well, in the case of Kananga, we call it the summary of rating. That is, it's a 6-page report. We cover about 120 stocks, and then we group the stock into different sectors, like say banking, for example. And then at the bottom of, let's say they cover 8 or 10 stocks in that sector, they will have the average. So you can use that as the average to make the comparison. To be frank, I don't really do that because I never try to estimate what is the fair price. My gut feeling will tell me this is cheap, and until it tells me that this is expensive, well, then I would say that this is cheap and this is a buy. Okay. I mean, I'm not supposed to say it's a buy, but yeah, it is cheap and it's worth considering for investment.
Okay, so then for the next question is, how do we calculate the intrinsic value of a company? Is there any calculator on any website?
They could be. I mean, there are different way of computing that, discounted cash flow and whatnot. I don't do that. It is way too much work, and calculating fair value or target price. I always like to believe it's like shooting another ship when the ocean is moving and everything is moving. It is very hard and probably not worth the effort.
Okay, so you will not attempt to
Yeah.
calculate the intrinsic value. And the next question is, if the company earnings have already dropped and the share price would have also dropped, so what do you think we should do? Should we cut loss or should we hold on? Because since it's already so cheap.
Okay, a recent case illustrates this point. If you go to my blog and look at ABMB, ABMB recently had a drop of in the earning about 40%, and the share price immediately plunged from something like 320 to about 290. Now, you must understand why the share price, the earning drop. The earning drop because of some provisioning made for large account. Now you must assume one or two things. Number one is that in the case of Airbnb being a bank managed by a Singapore banking group, I think DBS has some share or Temasek has some share. They are very, very, very thorough and very, very
Professionally run.
professional in their work. If they make a provision, it's not like they're going to stagger it over the next few quarters and you're going to be hit again with this sort of thing. They would have just cleaned the book and get on with it. So it's probably a one-off thing. And since the price has dropped so much, then it is really probably not worth the while to join in the selling. At the very least, you should just wait for a while and see whether the price would come back up. I felt that the price was trading at a pretty attractive level, so I actually call it a hold. You hold on to it and wait for the price to recover.
Okay. Now, how does a market cap of a company comes into play when we want to compare PE or PG of companies in the same sector?
I I never really take that into consideration. I mean, obviously, take for example rubber glove sector. You have the big four, Then you have the smaller company, Comfort and all that, and they are small cap. I I wouldn't look at the small one because you have the big one already doing so well and it's so competitive. I wouldn't take market cap into consideration. So I don't know how to do that actually. I am not sure how to do it. Yeah.
Yeah, but usually what I see is that the smaller market cap operating in the same sector usually command a lower PE compared to the
Probably.
bigger established one. Yeah,
Yeah,
but I have
probably.
never compared it against the PEG. lah. Yeah.
Yeah.
Yeah, maybe some of the smaller one like Kosan
Mm.
have a lower PEG valuation than Hata, which has double the PEG of Kosan. It's two something and versus one something, right? And people are really investing a lot for the future of Hata. Pay for the future price of Hata, okay, for the kind of growth rate.
Well, actually, Kosan is not too far away from Hata in terms of size.
Yeah, I think
Yeah.
Hata is probably uh, 16 billion or
You're
17
talking
billion.
about market cap.
Yeah, market cap.
Yeah, we're talking about profits. I don't think they are very far off. Yeah. Okay. Yeah, there's a fair discount to take into consideration because the bigger the company, chances of them surviving is better because your banker will be more supportive. If you get into trouble, your banker will probably have a difficult time to say, let's put a plug because you're so big. So yeah, there's always advantage in being big.
Yeah, when you're big, right, the
Yeah.
easier for you to raise fund from the bank.
Yeah, that's true.
Right. So now the next question is the KLSC shares have been dropping. So what is your take? Should we hold or should we consider cut loss?
Now you're asking me to make a prediction here.
No, it's like in this scenario, the participant is asking, in this scenario, what should we do? Do you think we should cut loss or do you think we should hold the fort?
I personally feel that the whole world has gone so crazy. They're talking about global economy being affected by the trade war and by all the rhetorics out there, and Malaysia itself also the politics is such a big disappointment. So you have all this negative being factored into the market. It is not surprising that share prices drop. So when you have so many things been factored in, it's all one way. It's negative, 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 right? So you would want to ask yourself this question: what if things start to turn positive? Yeah, I mean, one day after the election, or rather 2 days after the election, when we came back to the stock market, and we had one of the biggest rally in the market, which was a huge jump. There was so much optimism. Can you imagine the disappointment in the market after the May 2018 elections? And that disappointment, a lot of it is dragging down the market. So I felt I feel all along that I think there's too much negativity in the market, and I think that people should actually hold on to their stocks, and they may be surprised that in the end, it may be just a matter of 6 months or a year down the road. The market will be a very different market. I think it would be a market that is going to go up rather than go down. Yeah, personally, that is a prediction. I'm not going to base on any technical, but that's my personal predictions. I think that we are in a dark. It is darkest before dawn, so now we are in the darkest period, and I think that we'll see better time next year.
Oh, okay. So you feel that we should hold?
I think we should hold. Yeah.
Okay. All right, but of course, it's just presenter view. It doesn't represent
Yeah.
anybody's view. So, of course, we are not doing any recommendations. So you you do it at your own risk. Okay. Okay. Now is how can we calculate future share price or estimate? I think the participant is man is maybe
We had a few
forecast.
examples just now,
Yeah,
like the
we use
scenario and all that sort of thing. Yeah, actually, we we are trying to forecast what would it be like if, let's say, the market would take, say, more favorable view of Kosan, how much it can possibly go up. That, in a way, I did some computation for you. That is how you can do for your other stocks. You take the earning per share, right, and then you take the existing PE and you ask yourself these questions: Is this PE a fair PE, or can this change? Because right now the market is so bearish out there. Some of the stocks are trading at very, very low PE. And of course, the earnings also have been affected because the last 1 year we have been having a lot of uncertainty, a lot of economic slowdown. So the whole thing is going downwards. So if it turned, well, PE may go up, earning may go up, and the share price may just double up. I believe there is a possibility of that. Yeah. Back to you.
All right, so let me go to. Seems that there's no more questions, so let me go to the next webinar. Okay, so the next webinar is happening next Tuesday. It is a Chinese session that talks about how do we stay close to the market. Okay, which titled 如何贴近市场. Okay, so if you want to register for our next webinar, I have just put the link in the chat group. Please go to the chat group and register for it. So next week, we're going to talk about how do you stay close to the market and have the first, immediate information, publicly available information to you at the shortest possible time. Okay, so please register for our next webinar, and let me screen one more time for any possible questions. Okay, I believe we have covered all questions. Okay, great. So that's it. I want to thank all of you for staying online with us for this 1.5 hours, and for being a wonderful audience today and ask many good questions. I want to thank Alex, our speaker today, for spending your time with us to share your view about how the power of earnings can affect a company's share price, because I think that you have shown to us that the correlation between earnings and share price. Okay, and when there's a share price plunge, and then we can look at the PB ratio and probably buy below the book value and go in and wait for the rebound if the company business is still intact, and when the cyclical nature cycle comes back, and the company business performance will definitely pick up, and then now you'll be able to position yourself at the lower range of the company share price, and know potentially for multiple fold, like what you have shown us just now for one of the companies. So today we learned that earnings trend is also your friend, and earnings breakout is something that we should go in so that we can take advantage of the momentum behind the potential share price surge. Okay, yeah. Thank you for being a wonderful audience. My name is Shane Chu, and I'm glad to be your moderator for this webinar. So stay tuned for our Facebook and also our Instagram, our email for more information about next couple of webinars from LifeCham and Bursa Malaysia. Right, with that, thank you very much and have a wonderful evening. Bye-bye.